Okay, let's give every other person a minute to join in. Let's give every other person a minute to join. At least let's one more person join in before we start.
Michael is not here today. What's happening?
No one else has still joined. This might be a very valid trade on Euro USD, but this will most likely be my next week. So it's pointless placing this. We just see something like this happening. See something like this happening. The price revisiting now. Let me find a middle. Then money from them. So something like this can happen. Probably they just wipe out this high. Small thing. I've not really checked the target level as well. Something like this is very possible to happen before it comes down to whatever it's looking for. The thing is, when price opens, it's most likely continues with its previous trend. Altogether, can you hear me? Okay, market this here now. Yeah, good evening. Can you hear me? Yeah. So I'm with the other boy. This worker, can you hear me? Okay, good. So shall we get started? Today we're supposed to treat entry models. We are supposed to treat entry models, right? So let's just jump down to our GBP USD chart because that's where I have my notes and notebooks. That's one business my trend board. This GU shop, I've been watching it since morning, but I couldn't really get an entry. It really pained me. Alright, give me a minute, please. Let me adjust. Right, so entry models basically uh they are the things they are the let me just say they are more or less your queue or let me say the levels you are looking to enter trades from. And there are various entry models, right? And each of these entry model has its own rule attached to it. Excuse me. Each entry model has its rule attached to it. Now, I believe most of you have already heard about most of these entry models already in the past or something. Most of you know what order blocks are, you know what FVGs are, you guys know what breaker blocks are. You guys know what, yeah, most of you should know mitigation blocks. But a lot of people don't use mitigation blocks these days. So, then most of you guys would also know what QMLs are. But let us take them one by one. We're going to start with order block. Let's start with order block. Now, another block, right, another block, a dictionary definition or a textbook definition would be the last bullish candle before a bearish, last bullish candle before a bearish break of structure, or the last bearish candle before a bullish break of structure. That is a textbook definition. But then there are limitations to it. Like In terms of short-term highs and short-term lows, like I said, you use area where price changes its delivery for your order block. You don't use, so excuse me, you don't use the last bullish or the last bearish candle for your order block in cases like that. I don't know if you guys are getting me.
It's very beautiful.
All right, I said other blocks are the last bullish candles before a bearish break of structure in a market, or the last bearish candle before a bullish break of structure. That's the textbook definition. But then there are limitations to it. Like in cases of short-term highs or short-term lows, other blocks would be the area where price changes its delivery, the complete zone where it changes its delivery. That is, I've explained that before now, I believe. All together. Can you guys hear me?
Yeah.
Okay, so let's just pull out the chart first. We'll get back here in a second. So let's go down to the chart. So other blocks, the last bearish candle before, before a bullish break of structure. In this case, this is going to be it. In this case, this is going to be it. For the last bullish candle before a bearish break of structure, right? And in this case, this is going to be it. This is the last bullish candle. So in this case, this is going to be it. All together. Now, the limitations that other blocks have is it doesn't really account for short-term highs and short-term lows. When I explain short-term highs and short-term lows, this is when price engineers a high or a low, then comes back to take it out. When price engineers a high or a low, that's it. The high wasn't existing in the market initially, but price just engineered it. Something like let's see if I can just get. Let me just use a schematic to give you an example. Because I don't think I'll be able to find an example right now on this chart. So let's use this two. So we have price like this, we have this, right? Then we have something. Let's get this. Let's say market was selling, right? So it does this, swift liquidity, then it comes back here, and it doesn't go back to break this high, just creates a low, then comes back to breach this, right? Now this automatically becomes a short-term high, and the expecting price. Let's drop this two first. Now, since this has become a short-term high, it is safe to expect price to come, and this is where price changes to delivery. So it is safe to expect to see something like this and back up. Right, so this is an example of a short-term high trade, and this is where price changes its delivery. So this is the level used for your order block. Now everything from this point down to the retracement is going to be order block. Now, most times, if you're not careful, there might be liquidity lying below, so you have to confirm that. Now, if you're not sure, it's safer to take your stop loss to this level. Safer to use your stop loss at that level. You take your trade and it booms. So it is a very easy model. I think, let's see if this was what I used to get this Euro USD trade today. Sure, you guys can see my screen now. So let's see this. Okay, no, it wasn't. This is a different thing entirely. But then it plays out a lot on Euro USD, that's why I'm back tested. So it plays out a lot on Euro USD. I thought it was what I used to get trades. I'm going to just show you how it something. So that's the first thing. I think I've shown a lot of examples over time during the previous classes. That's the first thing to take note of. Now, the rules for order block. The rules for order block. Rule number one. Now, the first thing you must understand is that order block isn't a bias. Order block isn't a bias. Order block isn't a bias. Order block is more or less just an entry model. So which means you must know the trend on your own, you must know what price is doing, and you must know the areas of retracement before you can start looking for an entry of the order block. Now here are the rules to order block. Rule number one, liquidity must be swept. Like I told you guys yesterday, in everything you are doing, liquidity is the most important thing. Almost everything that has a rule, the first rule is always liquidity must be swept. That is always the first rule. That is always the first rule. Rule number two, structure must be broken. Structure must be broken. Either that or at least a short-term high or a short-term low should be taken out, or that is still part of the structure, so it has to be broken. Now, rule number three. Rule number one, liquidity must be swept. Number two, structure must be broken. Number three, the break. Okay, number three, it has to have an imbalance. There has to be an imbalance. There has to be an imbalance by the other block, or there has to be an imbalance where the structure was broken. So it has to create an imbalance as an SVG. Now, number four, the break should have displacements. That is for that block. Break should contain displacements or impulse, something like that, right? Displacements. I believe you guys know what displacements mean, right? You guys know what I mean by displacement. Can you guys hear me?
A large engulfing candle.
That's engulfing candle. Not quite, but yeah, you have an idea of what I mean. Now, what I mean by displacement is that once it breaks, there has to be significant movement from the top where it broke to where it starts retracing from, something like this. This was a significant movement first by retracing backward, and that's what we mean by displacement. Now, let me add a couple of rules. These ones are just more or less add-ons. Right? These ones are more or less add-ons. It isn't compulsory, but it is an add-on. So, number five, inducement. We're not treating with just what they call this thing, with just other blocks. So I'm not talking about where price changes delivery. I'm talking about an order block itself. You want to see an inducement before taking a trade. Now, in a case where there's no inducement, you're going to want to wait for price to engineer. Wait for price to engineer liquidity. So engineered liquidity and then take it off. Now, what I mean by an engineered liquidity is that it's a liquidity that didn't exist before, but price created it just for the sole purpose of taking it out. Something like this. Let's say we have a trade. Let's say we are trading into another block that lies here, right? And there was no inducement, so price might probably just come here, make a small move like this, and come back and sweep it before it goes backward. Now, this becomes an engineered liquidity because it didn't exist here before. But during the course of the movement, price engineered it just to take it out before the movement. Do you understand? Do you guys understand? I hope you guys understand. So that is just more or less an add-on. Now you just study this on your chart, follow the rules. You want to liquidity being swept, you want to see the structure being taken out. Then you want to see probably an inducement or an engineered liquidity. That is an add-on. Sometimes trade will be like that, but using an inducement, sorry. Excuse me. Using an inducement is more or less an added advantage for you. Right? Just more or less an added advantage for you. Now, yeah, that is going to be the first country model we're going to finish with. Let's see if I can just find one or two examples for you on the chat. So this market has been bearish for a while, so most likely we're looking for bearish order blocks. Let's see. Let's look at it for example. Alright, this is an example here. Liquidity swept, structure broken, displacement. Is there an imbalance? Yes, there was an imbalance between this candle and this candle. A very minute imbalance was there. And after the imbalance has been spotted, you can now see the last green candle. Let me focus this. You can now see the last green candle. Let's roll this out. This is our last green candle. Now you can always omit the down wick or the up week, as the case might be. Right, so in this case, I'm going to put it in a down week. As if price just came, tapped into it, and it sold down. Price came, tapped into it, and it sold down. Now, another big issue with other blocks is that some of them usually exist at the extremes, or at extreme levels, whereby sometimes price never really go back to visit. That is why we're going to be visiting the next entry model. But sometimes, if you say you want to keep using other blocks steady, you keep on missing your entries a lot. So that's going to bring us to our next entry model, which is going to be FVG or imbalances. Now, I've explained what FVGs are and what imbalances are. So, FVG and imbalances are basically the same thing. They're the same things. I don't know what I'm saying basically. So, these are just the gap that exists between three consecutive candles, right? Between the high of the first candle and the low of the third candle, or the low of the first candle and the high of the third candle, as the case might be. So, I'm going to explain what imbalances are. Here's an example I used when I was explaining it. Right? This is the first candle, this is the third candle. The gap between this high and this low is your imbalance. And those are gaps that price want to leave in the market. Now, taking trade off imbalances, after getting all your setups, all the requirements, like everything you have your bias, you know that this is what price is going to do. Next thing you want to know is what level price is trading on. Also to understand something, the fair value gaps or the imbalances that exist at the 0.5 levels, the 0.618 to 0.71 levels are usually strongest. Now 0.5 level can give you an initial reaction, but then might end up as an engineered liquidity. So if you're taking a trade off the 0.5 level, FVG, you wouldn't want to let that trade run for long. Sorry. So what I mostly do is I just get on to the I get onto the 30 minutes, sorry, to the 1 hour time frame. I spot out my 0.5 level FVG, wait for price to tap into it. So I drop down to the 5 minutes time frame to get an entry from there. Just target a very close area that I know price would most likely take out. Probably not even a targeted high or a low. I just look for the next PDRE. As price might most likely drive into. Target it, take my profit, and be looking for the short back down because it's going to still want to come back down. Or if I don't want to short, because I'm a scalper, I've told you, if I don't take the short, I'm just going to wait for price to now drive back into 0.71 level or 0.618 level. Look for my entry from there, look for an inefficiency, and take the trade. Remember, in a situation where you have multiple inefficiencies, that's seeing multiple fair value gaps, you're going to want to wait for price to trade into the fair value gap. You're going to want to wait for price to trade into the fair value gap. That is either of them. You're going to want to see a reaction. After seeing the reaction, then you're going to treat it more or less like a confirmation trade. Treat it more or less like a confirmatory entry trade, right? Whereby you wait for a liquidity sweep on the lower time frame, another liquidity sweep on the lower time frame. You wait for a breach, there's a break of structure or whatever criteria you use. Then you take your trade off the entry model you're using on a lower time frame. So that is what you do in a situation whereby there are like two imbalances at a specific level. I don't know if I made any sense, guys. Are we together?
Yes.
Yes, Isaac, can you come again
Sorry, I didn't
with
get
the
the thing you
situation?
said. I didn't get you. I didn't get you. Your
Isaac,
network is breaking up.
yes, the situation where you have to. Okay, can you hear me now?
Yeah, go ahead.
In a situation where you have two imbalances, how do you approach it again? Like I missed something, so I just want to
In
make
a
sure I get it.
situation whereby you have two imbalances, you treat it more or less like a confirmation entry trade. You wait for price to tap into the imbalances and you're looking for a rejection of it. Altogether, you're going to be waiting for a rejection. Once you've seen price giving you the rejection, you drop down to the lower tariff rate. I don't know why I'm yawning like this. It's like Jesus. If you drop down to a lower time frame, you look for whatever criteria you use to trade, probably liquidity sweep. Always look for another liquidity sweep on that lower time frame, right? That is a liquidity sweep at the point whereby it tapped into the FPG. And that liquidity sweep is always like the initiator. You see the liquidity sweep, then you look for other criteria, probably a break of structure, then the other block, a break of structure, or whatever entry model you want to do. Right? But then that liquidity sweep is always the initiator. Liquidity sweep is always the first confirmation you get. I don't know if that makes sense. Does that make sense? Emmanuel, I'm talking to you. Does that make sense?
Yes, sir.
Very good. Now the next one we're going to be looking at is we've looked at other blocks, we've looked at FBGs. We're going to talk about breaker block. Breaker blocks and mitigation blocks are more or less aligned, right? Just that the only difference, what's the difference in both of them? They are quite similar though. Now, the breaker block happens something like this, yeah? Let's say you have a market like this, then there's suddenly a sweep over here, and price drives down, nice price drives down. Now, instead of price coming back up here now to the 0 points, like going back up here, price comes and it tests from this level and drops down. And this is a breaker block. This is what a breaker block looks like. Right? This is what a breaker block looks like. This is what a breaker block looks like. Now you're going to use the other block that was filled here. The other block that filled here because there was definitely another block that was existing here, right? There was another block that existed there. The price just broke down. Now that is the other block that field you are going to use in this scenario for your entry. You're going to want to use it for your entry. So you're going to use it for your entry. You just put your stop loss right above it, right above the field, right above the field other block. All together. The rules remain the same. You have your liquidity sweep. Now, but this one has to break it with impulse. Most times you don't see it breaking one, two levels at the same time. It's impulse, like probably one candle or two candles or something, but you have to just hit. And now the last rule is that this part of retracement, this point where the retracement started, has to be this point where the retracement started has to be almost be above the 0.5 level over here. Let's roll this up. And it has to be above the 0.5 level. If it's not above 0.5 level, then you have no business with it. It has to be above 0.5 level. That is in the bearish scenario, and in the bullish scenario, it is vice versa. So it has to be above the 0.5 level. That is your major confirmation here. Does that make sense? Are there any questions,
Yes.
please? If you have asked.
Just a confirmation for this particular entry.
Sorry, you're breaking up again.
Okay, can you hear me now?
Yes, good. Go ahead.
All right. I said for this particular entry model, that's the breaker block, right? The
Yeah,
only
break up.
confirmation we should look out for is the retracement above the 0.5 level. That's all.
No, 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 no. Like I said, you want to see a liquidity sweep. It is always the initiator in anything. Then you want to see an
Okay.
impulsive break. You want to see an impulsive break, probably cutting through two highs or two lows, as the case might be. You want an impulsive break, probably cutting across two or more highs or lows, as the case might be. Now, the very closest other block that was what's the word that was ignored. Let's use ignored. So the very closest other block that was ignored here. If it lies below zero, sorry, if it lies above 0.5 level of this movement, that is before the retracement, then you can use that as your beta block. But if by any chance it is below 0.5 level, then that level is going to still be swept out most likely. Does that make sense?
Yes. Yes.
Okay. So mitigation block, I don't really think there's any difference between mitigation block. Mitigation block just occur a lot more in now when you see it a lot more in AMD setup. So by after like this for example now, after this happened, this was an AMD, right? After also this break, we just see price do something like this. Instead of price just rallying upwards, you're going to just see price coming back like this, something like this. Just going to see price coming back, something do something like this to tap in. Just tap it off the top of it or something, then continue upward. So this is a mitigation block look more like this, while a breaker block looks more like this. Mitigation block, you usually see it in a consolidating market. So it just comes back to mitigate orders or something. That is why it's called mitigation block. But most people barely use it. A lot of people barely use it. So are we together? Are we together?
Yes.
Okay. So I don't really want to talk much about mitigation blocks because it has been a really long time I used it, so I don't want to mix up something for you guys that isn't right. So it's something I've not used in a very, very long time, so I'm not going to talk much about it. Right? So then the last one we're going to talk about is going to be QML. QML. Have you ever wondered why heads and shoulder patterns are so strong? Why you see not wondered why you see why heads and shoulder patterns are so strong? When most times price comes back from head and shoulder, like once you see head and shoulder pattern, 80% of the time there is a major downfall. Now, because it confirms most of the rules. Sorry about this. Because it confirms most of the rules because here, let's take this as our this first movement here as indicator sweep. Just considering it indicator sweep. Now price breaks it. So if price does that, then price comes back here, breaks the structure, then returns back to like this. Price returns back. Right? So most times it comes back to test the high here. Right? Comes back to test the high, the previous high out of sweep. Just come back to test the high and it drops down. So your stop loss most times are going to be above here. But then I think there was something I learned from Dax this year basically, whereby he said, okay, I noticed it missed on some pairs, and he started using the other block here as failed instead of driving it above to the high, right? But most people prefer using the high because that is the original rule. That is the original rule of QML. The high that was swept. I don't know if you understand. The high that got swept. So let's see if I can just find an example on the chart for you. Just find one or two examples on the chart for you before we call it quickly. So let's see. Perfect. I think this can serve. Look at this for example. Let's take this. So I think here we can call this here a sweep, right? We'll call this a sweep. Let's see, using three candles, first candle, second candle, second candle, third candle. Okay, yeah. You still have a three candle schematic that follows all the rules. So yes, we can call it a sweep. Price did broke this structure over here. Price did is there a valid break? I might call this a valid break. Off the top of my head, I wouldn't have addressed that as a valid break of structure. So let's just look for a different example. It's left for me, I wouldn't address that a valid break of structure. Okay, yeah, it could be actually. Look at this. This was a short-term high, short-term low, it broke it. So you could actually use this. And there was displacement in it. So there was both displacement, there was imbalance and movement. Now price came back to rally. Look at it. This is the high here. This is the high that's so duplicated. So price came back to come and tap into the high over here before selling down. This is one example. Now let's look for a second example. Now this model doesn't particularly play out a lot. Like I'm not saying it doesn't play out, but it plays out a lot. But the opportunities you get are really limited because most times you might end up missing your entry. Most times you might end up missing your entries. Right. So this is another example over here. So break. Now this is the one that didn't return back to the top. We'll use this candle as its other block. So it's going to draw this out. We came back to test the failed other block before going back down. This is an example 2. Now example 3, it's the liquidity sweep. Yeah, we'll consider that. So let's see if we just get more examples for you guys. So here, liquidity sweep, structure broken, comes back to tap into the high here. Comes back tap into the high where the liquidity was swept. Right, so most times you're using QML to trade, it's going to be a first time trade. I don't know if you understand, it's going to be a first time trade, which means before price gives you this confirmation for something like this. So most times it's just going to end up being a first time trade like this. So you just most likely get it from the onset, from the initiation. Does that make sense? Does that make sense? Distribution. Can you guys hear me? Right. Are
Yes.
there any questions?
Will it be possible for you to give us a recording of your live trade?
I'm not giving a recording of
We want
my.
to
I'm not
see
giving
when
a
you're
recording of my live trade. We are having live sessions next week, whereby while we are trading, I'll be trading with you people basically. I think we'll have like 2 or 3 live
okay.
sessions, right? That's going to be within the week. I don't trade on Mondays, so it has to be
Okay.
Tuesdays, probably Tuesday, Wednesday, and Thursday, or Tuesday, Thursdays, and Fridays. Right? So it all depends on what next week provides. Is that
Okay.
okay?
Yes.
So next week, I would really appreciate if you guys are going to be active with us because since we're having live plays, the sessions are going to be in the night. But most of them will be in the afternoon or morning like that. So sometimes I get my trades like as early as 9 a.m. Sometimes I get them at 8 a.m. So the time for the sessions might really vary. So I would really recommend if we can be more active next week. Right? Because once I probably spot something, I'm going to let you guys know, and we're going to start a live session where we're going to analyze the market together and also like just help you understand it. Is that okay?
Very much. Yes.
So is there any other question?
We'll just go and study the entry models a bit more. Maybe next time if we have questions, we'll ask that. How about that, sir?
Yeah, I was about saying that you have to train your eye to accustom to most of this. You just go back to your charts. Thank God it's weekend, Saturday, Sunday. Go back to your charts. Just be scrolling back, be looking at all those things. Yes, you don't really need to just scroll back and be looking at them just to accustom your eye to most of these things. Right? So observe your rules, check where they play out. I think that's that. It's going to be as easy as that. Then we're going to talk more on today is Friday. We're going to talk more tomorrow evening. I think we're having a session tomorrow evening. So we'll talk more tomorrow in the evening. Because tomorrow is going to be the last theory session if I'm not mistaken. So the rest of them are going to be live trades. So we're going to talk more tomorrow evening. Is there another question? Or I can call it a night now.
Thank you.
So I can call it a night, right? So thank you guys once again. And good night. See you tomorrow by the same time.
Thank you.